So for those of you that didn't get PPP money, there still are other things that you can do in order to benefit your business and save on some expenses. So there are employer tax credits that you could potentially be eligible for if your revenue has slipped below 50%. You can delay making payments on your employer federal income taxes, and that's a real-time deferral, so you can see real dollar savings as you have each payroll. There's more detail and specifics as to how you could possibly meet some of the requirements for these, which we can talk about offline, or if you have follow-ups in the Q&A, we can do that as well. And then what we've been telling people from the beginning, which is renegotiate your leases, renegotiate your credit terms, renegotiate your bills, have conversations with your landlord if you're a tenant. These are the things that we've been trying to do to stretch cash out with business owners and to implement some of those real-time adjustments into our budgets and into our projections so that we can keep working with a rolling cash flow as time goes on. I will pause here to see if anybody has questions, and I'm working off of 2 screens, so between people on camera who are raising their hands versus people who are in the chat, just bear with me. Go ahead, Karen.
Any of these things available if they did receive PPP funds? Can you use any of these concurrently with that, or is this an and or situation?
So the 2 that I started talking about, which are the employer tax credits, which is up to $5,000 per employee, you cannot use that if you have PPP money. The other one, which is the delaying of payments on employer federal taxes, Andrea, can we use that with PPP money? I think that one we can.
Yes.
Yeah.
Yes, you can. And keep in mind, it's not the first one is a credit, so it's tangible dollars that you're receiving back. Second one is just a deferment of employer taxes, so it just becomes a liability for you. You will have to pay it. The benefit is cash flow now, with, of course, with the understanding that you're going to pay it back late in 2021 and 2022.
Right. And Karen, there are also, if you have anybody out who is on the special FMLA leave, either because they've been diagnosed or they're taking care of someone who's been diagnosed, or as in the case that we have at SKC, a couple people who are on leave because their children are home, because schools and daycare are closed, there are special benefits that you can receive for those employees as well as you continue to pay them. Any other questions or comments before we move on to a little bit more? I will go to some of the pre-submitted questions. One of the questions was, what were the payments from the government measured on? So my assumption is that question is about the economic stimulus money, which is $1,200 for an individual or $2,500 for a married couple. They were based on 2018 or 2019 tax returns, depending on if you had filed your 2019 tax return. What we're seeing, and Anj, correct me if you think that this is different, it looks like in order to get the money out the quickest, the government based it on your income as shown on your 2018 tax return. It looks like they went with that first. So if anybody, the cutoff, I believe, is $75,000 for an individual, and then the married filing jointly, Anj, is it $150,000?
I think they're phase outs.
Right.
So it's between 75,000 and 100,000 for an individual, and yeah, over the 150 to 200. I would have to double check for the 2,400 for married filing.
But what we are seeing is that it's pretty much based on the 2018 return.
Some folks who filed their 19 return, and when they received their direct deposit refund, they did receive the economic stimulus at the same time. So we're not sure if there's a correlation between your return, being available for, or being eligible for the stimulus money and them just giving it at the same time. That's very possible, but we have seen many more or clients who are eligible that have filed their 18, they've received it first.
Another pre-submitted question. I own an LLC and I file a K-1 to show my compensation. I didn't include my pay in the PPP application. Can I still include it in forgiveness? The answer to that is yes, you can still include it as a business owner, but you are capped at the $100,000 for the year. So within that 8-week period, it comes out to $15,385 that you can include in the forgiveness calculation for yourself as an owner. Okay. I'm going to switch back to our agenda, and I want to talk a little bit about the importance of doing a rolling 13-week cash flow. Really, you know, we've always heard the statement that cash is king, and that's really what drives a lot of our businesses. And when things are tight, as they are right now for many of us, this is the most important thing to keep an eye on, is really money in the door versus money going out the door. It's going to be, it needs to be constructed as a living, breathing plan. It needs to change and continue to roll every 13 weeks once you put actual in as 1 week passes and so on. But this is even more important for those of us that have gotten PPP money, because there's two very important things to keep in mind about the PPP money. There's going to likely be a portion of that that is not forgiven. And so into our future cash flows and into our budgets, we need to build in the ability to repay those funds over the required 2-year period. So that's the first piece that's incredibly important on planning with PPP money. The second piece that's very important that is not so highly publicized is what recently came out through the IRS about the tax deductibility of expenses paid with forgiven money. So the IRS recently came out, I think it was either Friday or Monday of this week, saying that any expenses that you pay using money that's forgiven through the PPP program will not be allowed to be deducted against your taxable income. So said another way, if you're forgiven for $100,000, those expenses cannot be taken against your taxable income. So in essence, you're paying tax on the $100,000. Now, this is incredibly controversial because it was directly in opposition to what Congress intended when they drafted the bill. And I know that the AICPA, our national CPA organization, as well as a whole lot of other folks, are strongly coming out against the IRS taking this position because it is so in opposition of how the language in the bill was written, which is there won't be any forgiveness of debt income. That being said, all of this is changing daily. So right now, with the IRS coming out saying that these expenses aren't going to be tax deductible, it's got to go into our planning because some people may have PPP money and paying these expenses and not their income, their revenue might not be down that drastically. So there's going to be an impact in your tax planning that's going to happen this year with money that you will be paying for these expenses that you might not be able to take against your taxable income. So that's come as a shock to a few people over the last couple of days. I just want to pause there and see if anybody has any questions or wants any clarification on that. Okay, seeing none. The other piece that's important as business owners, and I assume that many of us on this call, if not all, are business owners, is looking at what your personal finances are and rolling that into your cash flow. So you may be used to taking a draw or taking a salary of a certain level out of your business because of your lifestyle. What does that look like now? And how does that need to change? And how does your personal budget need to be tightened along with your business budget so that there's the potential to leave some additional cash into the business and not pull as much out as possibly historically we have. So as much as we go through the process of extending our payment terms with our vendors through the business and tightening and cutting expenses, what can we do as business owners on the personal side to keep as much into the business during this temporary time of constriction as we possibly can? one of the important things to calculate when we talk about the cash flow is basically our break-even point. So if we know that we've got a burn rate of cash every month that has to go out the door, we've cut everything, we've stripped it as lean as we possibly can, what is that number that we have to bring in the door every single month to cover that? And so that's basically our break-even point. And to start the calculation of doing our rolling budgets based on what that break-even point is. What do we need to bring in the door? And then how do we bring that in the door? And we can start tracking that. I like to do it on a weekly basis because all of these things are happening in real time and industries are being impacted differently from one day to the next. And so to keep an eye on not falling behind in meeting those obligations, I think is so important on a weekly basis. Some of the metrics that we've been advising our clients to really look at and create these comparatives over time are really the comparative revenue numbers month over month and quarter over quarter that you have comparing 2020 to 2019, as well as comparing the collections. So unless you're a point of sale organization and you've got, you know, collection terms and you issue invoices and then clients pay you over time, we really need to be monitoring those collections and comparing them to what did April look like in 2019 versus what did April look like in 2020. And this is even more important so we can see as business owners how our organization is changing and modify the things that we do into the future. But for people who have gotten PPP money, there's more than likely going to be a required piece at some point potentially to explain the economic impact that this situation has had on your business. And so we don't want to be at a point in the future where we need to go back and recreate what happened in this 8-week period. We want to be able to have real-time data and real-time statistics to say, you know, we've had a 10% decrease in revenue, we've had a 15% decrease in collections. AR and AP aging are incredibly important to look at, as clients may potentially be going over longer terms to pay you. These are the things that you need to demonstrate. You know, at SKC, we'll put together a one sheet that Karen can email out to all of you who are on this call, so you can see how to calculate these things, what to look for. A lot of what we do with our clients is visual, so you'll look at the AR aging over time in graphs, and you'll see as the aging categories start to grow as time goes on, how the aging for the collections is going out over longer periods of time. And these are the triggers that we want to monitor and look at so we can pivot and make changes. So go ahead.
Well, I was just going to say, I'll add, it's important to look at comparative revenue and comparative collections to prior years, but it's for all the things Sarah just mentioned, but it's also important for the planning of forecasting going forward and what the rest of the year looks like. We know that if we have a certain revenue and our receivables are collected in 30 days, potentially it's pushed to 40 or 60 days. If we know our average receivable collection is 30 and it may be longer, planning on cash flow, even though our sales cycle may still be strong, the collections may be behind. So we want to compare it to last year, but utilize that data to plan for our forecast and into the rest of 2020. It ties in very closely to the 13-week cash flow that's consistently being updated as we go through these weeks and months. But I think it's important that we're taking our historical information and using it to plan forward. Also, when we're looking at the comparison of P&L year over year, we can also see in an optimal year, if you will, and maybe that's 2019, what our expenses were in relation to our revenue. So if our new projected revenue is anticipated to be 50% lower, then of course we will adjust our expenses or need to plan to adjust our expenses to be in line so that our expenses are now in relation to our new projected revenue versus what it has historically been.